The one thing that worries me though is that there is so much speculation by retail investors in the markets. Call option volume on the S&P 500 is at record levels, and we're not talking about record levels by a smidge. We're talking about record levels that nobody's ever even seen before.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of another week for another weekly market recap featuring my good friend, the ebullient portfolio manager, Lance Roberts. Lance, how you doing?
I'm doing great. I have no idea what that word means. So
Yeah, ebullient just means excited, cheerful, uplifted, right? Which I think
yeah,
is a good set of adjectives for the market right now.
yep.
Stocks are feeling very ebullient. So let's just dive right into that, Lance. Is there a breakout in progress here? We just
Absolutely.
made new highs. Are we cracking higher here, you think,
Yep.
from here on?
And so now, of course, you and I are visiting here. It's early on a Friday morning. It's 9:55 Houston time. So markets have been open about an hour and a half or so far. But as we're speaking right now, we're sitting at all-time highs on the S&P. The Nasdaq actually set new all-time highs a couple of days ago. So, considering they both have very similar holdings, Apple, Microsoft, Google,
Yeah.
Nvidia, the top 10 holdings, the Nasdaq has been dragging the S&P up with it. So, but no, bullish wise, we've got breakouts across the board above resistance. Then we need to hold this through Friday. So, by the end of the day, if the market sells off and we're back, we're down for the day somewhat, in any at all. We actually finished right at all-time highs on Thursday. So if we're down 10 basis points by today, we won't have broken out. But as of we speak right now, if we finish the market positive today, we will have broken out on the S&P 500 to new all-time highs.
Okay. And when I say breakout, I don't necessarily mean just a new all-time high, but you have been saying for a good while in the program, stocks short-term overextended, expect a pullback here. Are you still thinking that, or are you thinking now, given the technical action, hey, maybe that's negated now and stocks
No,
are
no,
got room to run?
no. We actually had a pullback. It wasn't much of one, but we actually did pull back. If you kind of look at a chart, about a week and a half ago, the market had been rallying off support, and then we actually pulled back to support at about 59.66, based along that support for a couple of days, tested the 20-day moving average, and then on really kind of following talk about how fast narratives change, right? Over the weekend, last weekend, we're all talking about World War III because we bombed the nuclear facilities in Iran. I write a whole article on the fly Sunday talking about, okay, here's what's happening in Iran. This is the conflict worry, blah, blah, blah. And it was over Monday afternoon. So that article was completely outdated by 3 o'clock on Monday afternoon, but the
Right.
market
And sorry to interrupt, but the market didn't even care. The market
yeah,
opened up.
yeah, exactly. And so, we had this whole big narrative about World War III, and this was going to be terrible for markets, and that was over as fast as it started. But no, that's the whole point, is that by Monday afternoon, markets had rallied sharply, and we just rallied the rest of the week and have been running up to new all-time highs. Every narrative that's been talked about, recently, tariffs, debts and deficits, World War III, inflation, the Fed, all those narratives have basically just crumbled as markets are looking right through it, because none of those are affecting earnings outlooks. And actual earning outlooks are improving right now for the S&P 500.
Okay. All right. So I want to ask you more about that last point in
Sure.
just a second. Do me a favor though. Can you pull up? I know you're
I
playing
know.
hurt in terms of your laptop there. So folks, Lance still doesn't have his good laptop back yet. And we did a little bit of IT troubleshooting before we turned the camera on here. So just hopefully your computer can limp through this with us,
Yeah,
Lance.
yeah, yeah, yeah. Yeah, it's fine. So yeah, but here's a chart of the S&P 500. Again, this is early Friday, so again, be a little bit cautious that what we're talking about right now may change by the end of the day. You can see we broke above all-time highs and are right now sitting above that resistance level. Money flows have turned positive as well, which is, also important because money flows were declining. You kind of see that very minor correction that we had, and it built a bull flag. You had this compression of price as we headed down towards support. And then on Monday, we broke out of that tightening wedge pattern. That's what's called a bull flag. And we broke out of that, and money flows turned positive right out of that. So we saw a lot of money coming back into the markets over this last week. And really, it's chasing mostly AI stocks, stocks related to AI, and retail meme favorites. Those have been the big winners over the last week.
So a couple of things here. So can you zoom in a little bit on that bull flag?
Wait, zoom in on what? Oh, on this, on the bull flag.
Exactly. Yeah. So I think I think I speak for the average viewer here. I mean, pullback, I mean, there's so little wiggle room in that little bull flag there. I think people were expecting a pullback to be at least a couple of percentage points, at least, right? I mean, this is probably fractional percentage wise, but this was enough to serve as the pullback to let the market then really start to break out.
Yeah, you can see that RSI pulled back a bit. The MACD, which is your momentum indicator, it went from basically about 120 to about 50, which 50. So when you're in a bull market, momentum tends to stay between 50 and 100, right? When you're in a bear market, you tend to stay between 0 and 50. Same thing on relative strength. And so relative strength pulled back to 50, your momentum pulled back to 50, and so you're within a bull market. Yeah, you didn't get a big. So remember, there's two things about corrections. You can either have a correction in price or a correction in time. And, really, if you look at the market from a function, is that, yeah, you had this little minor pullback here on this bull flag, but really when it pulled back, you hadn't gone anywhere since May the 12th.
Right.
So you'd spent a month literally just going sideways. So you can have a correction in time, or you can have a correction in price. And I wrote about this a couple of weeks ago in our newsletter, saying I'm not looking for lower prices. I'm looking for a better risk reward setup. And that's what we got. So we added to stocks this past week, rebalanced our dividend model a bit. And so, we had that correction in time, which was enough to reset the table to allow this rally to occur. Now, I'm not saying this market's now set up and we're just going to run off to the moon here, but July historically tends to be a very strong month of the year, technically, particularly in a presidential election year. Markets tend to be up 1.5%-ish or so in the month of July. August, September tend to be very weak. So again, we may get this rally here and then have another 3 to 5% correction sometime in August, September over some event, earnings, economic data, whatever. The economic data is very concerning right now. It's slowing down dramatically. We just got some updated GDP reports that came in a lot worse than what we originally estimated. So we're definitely seeing slowing economic growth. That's going to impact earnings ultimately. And again, all that matters is earnings for the markets. So again, there's certainly concern here that this market's going to have to try to revalue itself a little bit as we get later on into the summer. Then that potentially sets us up for the kind of the more seasonally strong end of the year rally in November, December. So, if you miss this rally, don't sweat it. You're going to have another opportunity to buy some stuff cheaper at some point here in the near future.
Okay. So I think it feels like I heard a contradiction that you just said, Lance. I'm probably hearing you. So a few minutes ago, you said, hey, stocks are breaking out and earnings outlooks are improving.
Yeah.
And then you just said, hey, economy's weakening and then earnings are going to have to reprice for that. So what is the situation right now on earnings?
Well, no. So right now, analysts are getting so earlier in the year, in January, February, March, analysts were very optimistic. We published some earnings charts you and I talked about where we had this very kind of $260 a share in earnings, those type of things. And I said those are very that's too optimistic. And then we had this Liberation Day, this tariffs, all these things going on, and analysts cut their estimates by a fairly large margin. So we saw this reduction in earnings. And that was during that 20% correction that we had within the market itself. Now, analysts are going, okay, I overcorrected for tariffs because tariffs aren't really showing up. There's no inflationary impact. We're not seeing any big tariff impact to the overall economy right now. Companies are able to basically handle the tariff rate at where they are. Nike just did their report. They're going to take $1 billion hit on tariffs, but in terms of their outlook, that was negligible. So the stock's up like 11% today on that news. So it's a minor impact. So now analysts are going, okay, I overcompensated on the downside. So now they're getting optimistic again and ratcheting earnings back up, but they're not paying attention to what's happening with the economic data, which is continuing to deteriorate at a fairly good clip. We're going to see the June employment number come out right after the first week of July. And when that occurs, I suspect that we'll see the 139,000 jobs we saw in June will get revised down closer to 100.
Yeah, I'm going to bet it's going to be sub 100, but we'll see.
Yeah, I'm just round numbers.
No, I know. I'm just for fun. I'm just taking the under. So
okay, you take the under, I'll take the 100. But because we've seen that's been the trend lately, that these numbers are being overestimated. But you just saw the GDP report, the third revision, which is the final revision for the first quarter, went from negative 0.2% GDP growth in the first quarter to negative 0.5.
Right.
Personal consumption expenditures got revised down. Personal incomes there was a bit of an anomaly to the personal income data today that came out. So disregard that this month. We'll pick up with it next quarter.
Okay. But I am going to mention a little bit in a bit. But anyways, have your caveats ready.
Yeah. But personal spending was a lot weaker than expected. That's the driver for earnings, is personal spending. So right. I think that still analysts are too optimistic about earnings. And we're going to have, if this economic data keeps weakening, I think we're going to see those analysts have to start cutting some estimates again for this year. And again, I still think they're too high. So that's what I'm saying. I think August, September, maybe early October, we're going to get this kind of revision to the markets and see a little bit of weakness here. And I'll give you a better opportunity to pick up some stocks at that point.
Okay. And just to make sure I heard you correctly, you think that analysts are increasing their earnings expectations right now because tariffs and stuff weren't as bad as they thought it was going to be.
Right.
But you think that they're wrong to do so because the underlying economic data is worsening.
Exactly.
Yeah. Okay. All right.
I think if they would leave things where they are, they would probably be better off. But hey, I could be wrong. We'll see.
Okay. So a couple more things, and then we got a lot to plow through here. Because we had the mini micro pullback, and stocks have now broken out, are we off to the races now? Like, do you expect in the near term here, us to start going to new high after new high?
Well, look, historically, when markets break out to a new high, that really excites the bulls. And so once you get new highs, you typically make more highs after that. So there's a very real possibility this market's going to run a bit more from here. And particularly, like I said, July tends to be a fairly strong month anyway. So, to get to 61, 6,200 is not going to be a stretch for this market right now. But again, we may get to 61, 6,200, then turn right around and pull back to 6,000, retest this breakout before we set up for the end of the year. So, again, just because these things are happening, I wouldn't be overly, I got to get in type thing. Markets are overbought now, again, short term. Just on a relative strength basis, we're back up to above 70. So again, markets can remain overbought longer than you think. But again, there's a lot of narratives that are falling by the wayside. You'll remember back in March, April, it was all about the death cross, right? The death cross has occurred, the S&P and the NASDAQ, and that means the bear market started well. The NASDAQ is now back on a golden cross, and the S&P is going to probably do a golden cross next week. So all these bearish narratives that I've been warning about we've written articles about it. We talked about it here on the show. Is you got to be really careful with these bearish narratives because the market is not paying attention to those, and it's looking right through that data and looking at the only thing that really matters, which is the impact to earnings. Remember the whole death of U.S. exceptionalism. Now we're seeing Europe sell off, and we're seeing money flow back into the AI trade. So AI is back from the dead, right? So. Every time we have these narratives, it's so important to step back and look at fundamentals and not worry so much about these headline narratives, which most often turn out to be wrong.
So a couple of things. First off, I want to give you kudos. One, you've been beating the don't follow the narrative drum for a good long while, and you're showing here now. You're taking your victory lap of, hey, folks, I told you, right? I also asked you
I don't want
multiple.
to say that. I don't want to go this "I told you so" thing because that's not what I'm doing. We're just you and I are here to talk about how money works and how markets
It's
work.
just validating of what you've been saying. Let's put it
Okay,
that
that's okay. Yes, and I've been lucky this time. So again, I may be wrong next time. So
way. Okay. Well,
that'll help me.
another point you've been right is in the past when things have happened geopolitically, and in the recent past when I've asked you specifically about what was going on with Iran and Israel, you had basically said, look, unless it really spins out of control, the markets probably aren't going to really care about it. And, again, everybody last weekend, after the bombs dropped, the debate was all about how deep is the market going to open, on Monday, 15%, 20% more, right? How high is oil going to open? And then the market just completely confounded everybody by doing the exact opposite, right? So your
Yeah.
point was again validated there. So kudos to you. Also, it's important to remember, keep some of these old adages in mind, like bull markets climb a wall of worry. And as you said,
Mhm.
Lance, there were lots of worry points this year. Oh my God, we might be going back into recession. Oh my God, tariffs, Trump's destroying everything. Oh my God, we're going to have World War III. In many cases, that's when a bull market says, oh yeah, well then hold my beer, right? And that seems to be what's going on right now.
Yeah.
So a couple questions around this, then we'll move on.
Sure.
There are some people that are now saying, okay, maybe what happens here is we end up kind of getting a blow off top of the markets where things just, really get really exuberant. We've kind of run out of worry, right?
Mhm.
So everybody jumps in because of the momentum, but the wall of worry that allowed the bull to climb is now done. And things get really overextended. I'm not saying you're going to call for that, but is the potential for that increasing here?
Oh, absolutely. I mean, whenever you get these breakouts like this, I would be more concerned. So, if we two things. One, so we had the April 7th, kind of bottom in the market, right? We had that very sharp sell off, nearly 20% between, March and early April. If the market had run straight back up to where we are now without taking that consolidation break for a month and a half, I'd be a little bit more worried about, a melt up at this point. But we did take a good period of time and allow the markets to kind of recalibrate themselves a bit. So that allows the markets to run a bit more. Now, but that doesn't mean that we can't just have this market just kind of go ape because there's, the thing that worries me out of all this is that just stepping back and looking at the markets are doing what markets do, and they're doing it in a fine manner. The one thing that worries me, though, is that there is so much speculation by retail investors in the markets. Call option volume on the S&P 500 is at record levels, and we're not talking about record levels by a smidge. We're talking about record levels that nobody's ever even seen before. The number of the amount of flows into ETFs, active ETFs versus passive ETFs. Active ETFs have now surpassed passive ETFs, and we're seeing this huge predominance of money flowing into leveraged ETFs, single stock leveraged ETFs, those type of things. And that's just taking on speculative excess risk. And one thing we talked about a lot this week, this hasn't happened yet, but this is a sign that you're reaching more of a speculative nature in the markets. Quick recap: in 2020, and coming out of the pandemic in 2020, and then particularly in 2021, there was this massive surge of money going into the markets because everybody had money to spend, but there was nothing to spend it on, right? You couldn't go out to eat, you couldn't go to a sporting event, you couldn't bet on sports because there was no sports to bet on. So everybody turned to the stock market, and we were speculating in AMC and GameStop and cryptocurrencies and whatever was going up, right? We were just throwing money at it. And Wall Street could not come to market fast enough with product in terms of ETF generation or IPOs. And so they go, well, we got so much demand for investors, we'll do SPACs. And of course, if you don't remember what a SPAC is a fund that you put money into, but the fund has no plan of what to do with the money. They're like, give me the money first, I'll go find something to buy.
Mm-hmm.
And that is the height of speculation at that point. But that was Wall Street meeting demand for investors. And one thing we talked about a good bit this week on the Real Investment Show was that right now there's a big push by private equity to get private equity into the public market. And in other words, private equity for a long time has had a big allure because it has, much lower volatility relative to the market, has higher returns relative to the markets. Well, the only reason it has lower volatility is it only prices once a quarter. So you don't see
Exactly,
all the
because it's not
volatility.
liquid. Yeah.
Yeah, it's not liquid. Well, once you push that into the public market, you destroy the volatility part of it. It'll become very volatile because of mark-to-market accounting and buying. The second thing is that the returns are going to go right to the return of the market. But there's so much demand by retail investor for product that private equity is going, you know what? Here's a great funnel. We have all these deals that are coming in. So let's just play, for instance, that me and Adam are a private equity company. We've got access to high net worth investors all over the world. So we get the next Uber or the next Tesla, right? That one comes in as a private company. It's the next Tesla or the next SpaceX. So we give that one to all of our high net worth, super liquid, private investor groups. The world doesn't see that on the public side. I get this other deal that comes in. It's like, yeah, it's a so-so company. It might work, it might not. We'll see what happens. We'll give that to the public market. And so this is a way for private equity to basically shelve off all their kind of subcategory type second tier companies that they want to bring public because now they have a ready and willing buyer for it, being the public market. Or these will be deals that, super astute, high net worth investors go, yeah, I'm not interested in that one. Doesn't fit our criteria. Now I've got a public market to shove that off to.
So let me just
not,
interject with one thing on this because I'm sure that's going to happen. What I am even more concerned about here is that private equity is a lot of their businesses are undergoing the stress that a lot of other businesses are going under too. And you're stuck with these dogs on your book because they're liquid and you maybe can't even sell them because there's no buyer. Now they can package all their junk and dump it out. So not only are they giving you the new deals that aren't so great, they're deliberately selling you their junk. Yeah.
Exactly. And now they want to and they're actually trying to lobby this to put this in the 401k plans as well. But my point about this is that's just the latest iteration of this. And that's because of all this speculation that's going on in the markets. And again, like I said earlier, what's driving the market right now? It's AI stocks. It's retail favorites, called the meme stocks, whatever. And it's basically companies that, are kind of in the second tier of large caps that have a lot of momentum in them. But outside of that.
And this sounds and smells just like December 2021, right?
And a lot. Well, in fact, what's interesting is if you take a chart of the Nasdaq from kind of February of 2020, and overlay a chart of the Nasdaq now, they're tracking each other. You had the 35% decline in 2020. You have this 20% decline now, and the rallies are running very similar at this point as well. So you're seeing that same type of activity that's occurring. And so, look, I'm not saying markets are going to blow up. I'm not saying that at all. But what I am saying is that there's so much speculation in the market that you have to be aware when we're talking about a melt up, that that's very possible given this market and the amount of speculation in it. But that also means at some point, whether it's next year or the year after, whenever it occurs, we're going to have another, sizable correction that all these retail investors that are heavily speculating in the markets are going to lose their shorts once again. And again, it happened to them in 2022. The average retail investor was down 40 to 50% while the market was only down 20. And that was because of that speculative bias that they took. That's going to happen again.
Okay. So you, to date so far this year, have thought that the market was, going to end the year relatively flat, maybe up a little bit, but not a blowaway year. It sounds to me like you're still thinking that's where the smart money's on. Now we may have a blow-off spike in between now and then, but it doesn't sound like you think that today's asset prices and their current upward trajectory are supported by the fundamentals, because you think earnings estimates are probably going to have to come down here at some point. So you're still expecting a volatile year ahead.
Yeah, look, I think that probably this year could end. We started out this year, right around 6,000-ish, and we got to about 6,100 in January, February, March. I mean, we could wind up this year anywhere between 5,900 and 6,300.
Yeah.
I think we'll end up on the upside. I think this year we'll finish on the positive side, but I think you do have a bit of a pullback here, probably September, October, August, September, October, somewhere in there. That would be reasonable. And then you get this rally at the end of the year that basically gets us to, 6,150, 62, 6,300. Anything's possible, right? But we've had two 20% return years in a row over the previous 2 years.
But-
So, a year and the whole call this year coming into this was a year of more volatility and lower returns. So, if you wind up making 6, 7, 8%, that's probably about right given where we were last year. But you're going to do that with a lot more volatility, which, well, we've already seen that this year.
Right. And if you make 5%, hey, you could have just been in T-bills the whole year and slept and, done almost as well. All right. So we'll move on from here, but just real quick, totally hear your concerns about both where earnings are likely headed, the speculation, the rampant speculation that's in the market. I think it's a fair adjective to use. I think you kind of alluded to this, but I just want to make it clear. We have breadth concerns again in this market, right? Where it's highly concentrated in those AI names and whatnot. It's not a broad market phenomenon here. And I just want to get your thoughts on this. So you're nodding as I'm saying this, just folks didn't hear you there, Lance. But I've had some people on the program recently note to say one of their worries about this breadth-wise is that 2021, the Mag 7 was really pulling the markets higher. Right. And while the AI trade, yes, is pulling things high here, they're like the Mag 7 is not really fully participating in this. It's more like the Mag 2, or Mag 3. So, I mean, are we seeing breadth concerns because even those powerhouses, we're now starting to see members fall out of it?
Yeah, I mean, Apple's really been a drag so far this year. Google's been dragging a bit. Tesla's really been the big drag over the course of this year. That whole spat between him and President Trump certainly didn't help the stock there near term. But so if you look at the number of stocks trading above their 50-day moving average, we're at about 74%-ish, 75%, somewhere around there. That's not an exorbitantly high level of stock. So, but it's decent, right? So the number of stocks participating in the market and rallying above their 50-day moving average is about where you would expect with this type of rally that we're in. It's the stocks above their 200-day moving average that is more concerning. That's right now, that's around 56% of stocks above their 200-day. It's not terrible breadth, but it's not what you would expect given the strength of the rally so far, particularly since the lows, which goes to the point I was saying earlier, is that this rally's been driven by AI, retail meme favorites, second tier AI, companies like CoreWeave and Oklo and those type of things. So it's stuff related to AI that's kind of at the next tier.
AI adjacent,
yeah. You take a look at companies like Procter and Gamble, Kimberly-Clark, kind of your more kind of stable companies. Those kind of value-oriented dividend stocks are not really doing fantastically well this year. They're kind of treading water. They're not getting killed, but they're also not participating with the market on a relative return basis.
Okay. All right. So again, reasons for concern, why largely you think that this year probably will be single digits up, if it's up at all. And we'll find out. We'll keep tracking this.
Just so we have it on record, I do think we'll end up in positive digits.
You're on record. Yep.
Okay.
Yep. You're taking the over on the positive.
You take the under.
But you're thinking probably not going to be much higher than 5%. Yeah.
Yeah, 5, 6, 7, 8, somewhere around there.
Yeah. Okay, so let me ask you that. I want to get into some of the economic weakness that you referred to earlier. But before I do, just as a bridge from markets to that, I'm going to go through a list of things and ask you, could this add additional jet fuel to this bull rally that we're now on, right? So we just talked about how maybe it's not fully supported by the fundamentals and may blow off at some point in time. But let me just go through this and then ask a high level question.
Okay.
Or maybe I'll ask the high level question and then give you the supporting points. So this is not political. I'm not endorsing anything here. I'm just saying, I mentioned this a few videos ago, and I now feel the need to mention it again, which is the Trump winning quotation marks scenario, right? So if the following indeed happens, Lance, right? Um, if trade deals really start getting knocked out here, and we had a headline this morning saying, where Trump had said, hey, we've actually signed with China, right? And it doesn't sound like a China deal is fully struck yet, but the Chinese have confirmed that progress is being made, right? So that's heading in the right direction. And the administration is guiding us to basically expect a signed new deal with China soon. And that was the one I think everybody thought was going to happen last, right?
Right.
Lutnick, who's been saying this, but just said, hey, we're super close with 10 other big countries, and that stuff should be coming out soon. So just give them credit for right now. Let's assume that stuff happens over the next month or so, right? That we really start locking in these big trade deals, including with China. If you look at inflation right now, Lance, very muted, right?
Right.
Everybody was freaking out, March, April, coming into May, that inflation was really going to pick back up again. We got the PCE numbers today. PCE headline came in at 2.3 as expected, year over year. Core PCE, and I know there's some issues with it, you said, but that was only slightly higher than expected, came in at 2.7% year over year. That's not a runaway inflation number. BLS current CPI is 2.4%. Trueflation, an alternative means of measuring it, they coming in at 2.18%. So again, these are not runaway inflation numbers by any stretch. We're not quite at the Fed's 2% target here, but every number I just mentioned to you has a two handle on it, right?
Right.
We just got the latest Michigan confidence data, and inflation fears have plunged the most since 2001. So remember that a lot of folks were freaked out by inflation. I had inflation concerns. I had Joanne Shu, who directs the University of Michigan research on recently, and she was saying it's all about fears of tariffs and the inflation they're going to cause. That seems to be moderating now. This is a crazy one, but what if we actually have peace in the Middle East now, right? We just had this action with Iran. Assume for a moment that Iran maybe becomes much more conciliatory, because maybe they have to be at this point in time. We just had a floated proposal yesterday, jointly by Netanyahu and Trump, about a deal for Gaza, where basically, Israel is saying, look, we're willing to do a ceasefire in the next couple of weeks, and here's all the things that could happen. And a lot of this was like other Arab nations come in and either take some of the Gazans in their country, or end up taking control of Gaza instead of Hamas. A lot of the things that people have been sort of hoping for and talking for forever. Who knows if that's going to happen? But again, just in this work exercise, mental exercise, just assume that happens, right? The big, beautiful bill looks like it's going to pass in some shape or form. Deregulation's going on. Doge, which everybody has kind of given up for dead, I mean, is still making a difference. It still is saving billions of dollars. We just got the biggest drop in Social Security payouts ever, because they removed all the people that were in the system who were like 150 years old and older than that, right? So we are beginning to see some cost reductions. I'm not trying to totally oversell this, but all I'm doing here is just banging through a whole bunch of things that have momentum and could work. And my question is, Lance, is if they work, right? How much of a premium should the market be putting on here in addition to what it's doing right now?
Like Trump said, you're having so much winning, you're going to get tired of winning.
Yeah, exactly.
So,
I know. So
uh,
let's assume he's finally right on that.
yeah,
Everyone's like, we're winning right and left, right?
there's just too much winning. No, look, seriously, a lot of these things are already priced in by the markets, and the markets are already seeing these actions occur, and they're pricing that in already. So again, those aren't going to provide a huge amount of upside from here. Now, the
Or they
bigger
are or
risk
they
is
aren't.
they are not going to
Okay.
provide a lot more upside, because they're already expected to occur. So markets already pricing for that. What markets aren't pricing for is, let's say, for instance, one of the big concerns I have, if there's, what you're always looking for in the market is the unexpected exogenous event that nobody's counting on.
Mhm.
And as I utter this, I'm going to take this particular worry right out of the mix, because
Because you thought of it.
yeah, because I've thought of it, and the market probably has too. But there are challenges going on with the big beautiful bill. It's going to have to go back to the House for reconciliation, which they'll have to vote on it again, and they only have one vote to lose there. So if the deal doesn't get passed, and they can't get the bill through, the Tax Cuts and Jobs Act will expire. And when it expires, that's a huge tax increase for corporations as well as households and individuals, because tax rates will revert back to where they were before the TCJA. That is an impact to earnings, and that will matter a lot to the market. So the market right now is counting on that big, beautiful bill to pass. The risk is something like that one doesn't, because see, that one directly impacts earnings. Peace in the Middle East is great. The only people that really hurts is defense companies, because they won't have anything to sell missiles for. Right. So you solve your big problem there. Defense companies are dead theoretically. But
Although,
this,
on the flip side,
yeah,
and look, this is me just
sure.
again, total mental exercise. The probability of this is probably pretty low. Is what if we get to do the bear hug in the whole region now? And now, war fears are going down, and we start really doing deals in all these countries in a way that we couldn't before, right? And it's a thousand flowers bloom in terms of all these new great deals we can strike, right?
That's great for markets, right?
Yeah.
Because again, that would improve earnings across the board, right?
Right.
So if you could structure deals where nobody had tariffs on anybody, that'd be great for earnings, right? Because now we can trade freely between all countries, and it'll be fantastic. And the sun will shine, and it will never rain again. It'll be San Diego weather, 357 days of the year, right? It'll be beautiful. That's probably not going to happen, but that would impact earnings. The passage of the big beautiful bill will help earnings, because it'll keep tax rates lower. But see, the tax rate's already factored into current earnings, so that's not a huge boost if they pass the bill.
Right. It's an avoidance of the pain you were talking about if the tax cuts get reinstated. Yeah.
Correct. That's
the
bigger risk. Yeah.
Yeah.
But no, look, I think everything you're pointing out is fine, but most of this stuff is already factored into the market. So, like I said, all those walls of worry, because basically all you were talking about was everything everybody else was worried about prior to these deals. Oh my gosh, these tariffs are going to be terrible. Well, now we're getting tariff deals done. And so the market's been rallying, 20% up from the lows already. We're already back in a bull market for the NASDAQ. And so that's already factoring in all those things you're talking about.
Yeah. And my question was more, not so much like I think the fears on tariffs was, oh gosh, world trade is going to get a lot worse, right? Because it's going to be this big tax on the American consumer, and countries are going to be pissed off at us, and it's just all friction and additional cost. That's getting removed as people are saying, oh, okay, I think we're going to avoid that. My question was more on the upside, right? Of like, hey, not only did we avoid that stuff, but there's a lot more that we're getting in my thought exercise here, folks. I'm not saying Trump's going to pull all this off. I'm just saying, let's assume for a moment, if he did, what would the upside be in the markets? I hear what you're saying, Lance, is probably most of that's priced in. Yeah. Okay.
Yeah.
And then I was going to ask you on the downside, but I think you already kind of went there. I mean, obviously.
Well, you got to step back for 1 second, right? So if you take a look at what's going on in Europe, right? The ECB has cut rates 8 times. The Swiss National Bank just went to 0 interest rates.
Yeah.
They're reinstating NERP. You're not doing that if your economy, this was my whole theory earlier this year. I said, is like, everybody's running, it's like, sell America, buy Europe. Why on earth would you buy Europe? Their economies are in disaster.
Exactly. Yeah.
And they're having to cut rates to try to stimulate activity. Germany is on the brink of bankruptcy at this point. So,
and they're all being forced now to spend more on defense. That's just additional cost. I mean, it'll help their defense industries, but beyond that, it's a cost to everybody else in Europe. Yeah.
Exactly. So why on earth would you be shifting capital over there in terms of this, sell America and buy Europe? It makes no sense whatsoever. One of the other narratives right now, and I've got an article coming out on this next week talking, I actually already posted it, called "The Death of the Dollar is Greatly Exaggerated." You're getting to the point to where, as those yields come down overseas in terms of those sovereign debts, that 5%, 4.5% yield on U.S. Treasuries is going to start looking mighty attractive.
Really good.
And if you start seeing the dollar rally, all of a sudden now I've got foreign reserves at lower rates where I'm losing money. I move that money into U.S. dollars, buy U.S. Treasuries. I get a higher yield and a currency appreciation. So there's a real potential setup here that sometime later this year, we start seeing a fairly substantial rally in the dollar, and yields on bonds start coming down. And particularly now, that the SLR is the rules behind the supplemental liquidity ratio for banks has been changed. I've got an article coming out on that on Monday explaining exactly what that is and how it impacts banks, and more importantly, how that potentially impacts the treasury market, because that's going to provide a whole new leg of buyers for U.S.
Demand.
treasuries,
Yeah.
starting fairly soon.
So, all right, Lance, it sounds like you've been drinking from Brent Johnson's Zoller milkshake recently, because
Dude,
it's basically.
I am older than Brent Johnson. He just named it. That's all he did. He
All
took
I'm
my
saying is
recipe and named it. That's it.
I'm just saying you guys are looking at the world similarly there.
No,
Yeah,
I like Brent. I like Brent. If you're watching, I'm just teasing, man. It's all good.
I'm sure he's flattered. And we can get more into the details of the SLR revisions next week after your piece is out, Lance. I think it'd be useful to do. But to your point, just want to underscore for folks, basically, the Fed is telling banks, you know what, you can basically, we're loosening our reserve requirements, and you're going to be able to buy treasuries with a bunch of capital that you weren't able to before. And so basically the banks will say, great, we'll go do that. And that's going to put a lot of incremental marginal demand on treasuries.
Yeah, about 25% of GDP's worth.
So that's nothing to sneeze at. I mean, that's
No.
yeah. So yeah, so okay, that's an argument, and we can talk about this directly next week. Is that an argument to go long on the Treasury curve right now? You can save your answer until next week if we want to keep folks in suspense.
We will. We'll keep in suspense.
Okay, we'll make sure they go to Real Investment Advice and or to go to your Substack to wait for that piece to come out next week. Okay, so we talked about what the markets are doing. We talked about whether additional good news, even the triple Lindy Trump sticks the landing on everything, what that could do. We talked about some of the things that could go wrong in the market, sort of black swan wise. Let's talk about the white swans now that could impact this market. So a couple of things I want to go through here. Basically, student loans, housing, and unemployment. So let me just read this thing. I read this the other day on my video with Stephanie Pomboy. This just came out 2 days ago. Nearly 1 in 3 federal student loan borrowers are at risk of defaulting on payments as early as July, as delinquency and default rates soar in the wake of pandemic-era repayment relief ending, right? So this was the last bit of forbearance that was out there in the consumer credit world, and this is the one form of consumer credit you can't dismiss in bankruptcy, right? So you got to pay this. About 5.8 million federal student loan borrowers are already 90 days or more past due on their payments as of April 2025. That's roughly 31% of borrowers with a payment due. Okay, so that's pretty bad, right? Almost a third. That's up from just 20% in February and nearly triple the 11.7% delinquency rate reported in February 2020, just before the pandemic began. The April figure represents the highest delinquency rate ever recorded, right? So these things have just gone back into repayment, and we're already at the highest delinquency rate ever reported, right? And as you and I know, Lance, most people, they just adjusted their spending because they had years of not having to pay this stuff. And of course, the narrative at the time was the Biden administration was doing its best to cancel all this stuff. So why worry about this? I'm not even gonna have to pay it back in the future anyways. Yeah. Right? So now people are, probably a lot of people caught flat-footed by this. Of course, the cost of living has exploded over the past several years. And so, they probably now need this money to make ends meet. So we've talked about this of the credit contagion factor here, right? So, student loan delinquency is already spiking and defaults spiking. We are seeing other forms of consumer credit start to really increase in delinquencies because people are like, well, I've got this new bit of debt, this new kind of debt I got to pay. So I got to maybe steal from my credit card payment or my auto loan payment or my mortgage or my rent or whatever. And so, there is the potential, I'm not saying it's going to happen, but there's the potential here for this to be kind of like a subprime cascade, right? How concerned are you about this given this data?
No, this is exactly what I've been trying to talk about. Well, the one thing that you didn't mention in your statement was that 6 million borrowers that are now delinquent 90 days or more on their student loan payments are now subject to wage garnishment. there's two types of debt you don't mess with in the world. That's IRS debt and student loan debt. Everything else, credit card debts, those type of things, you can battle those in court, write those down, et cetera, discharge them through bankruptcy. You don't get rid of IRS debt or student loan debt, and both those agencies have the ability to garnish your wages. So we're going to see we're going to see these 6 million borrowers all of a sudden walking around going, I now have less money to spend in the economy. And this goes back to my concern earlier about the economic data. I think that economic data is a lot weaker and will get weaker as we go further into the year.
So I totally agree, and I'm glad you brought it to consumer spending, because that's what I think is the big punchline here. Let me just add two other things into this. So we're continuing to see, I would say, an acceleration of deterioration in the housing market. You and I talked one of these recent weeks about the recent data that came out showing that there are now substantially more aspiring sellers than buyers in the housing market nationally. And that trajectory is just like, it's on an exponential right now. So it looks very much set to continue, and for that gap to continue to grow in future quarters here. We just had data come out this week. New home sales in the US month over month change was 14% versus a forecast of less than 7% drop. The previous month it had been a positive 11%. So we're basically seeing just demand continue to dry up as more and more inventory keeps coming on the market here, right? So that's another factor from like a negative wealth effect standpoint that compounds with what's happening there in the student loan world. And then unemployment. So I think you last week, Lance, were talking about, hey, we're really starting to see some movement in continuing claims here. That's, it's not at crisis levels by any stretch, but it's beginning to pick up momentum, right? So the latest continuing jobless claims data are now the highest since November 2021. If you look at the recent college graduate unemployment rate, I'll try to pull this up as we're talking, but that is really starting to spike. And the thing to note about that is, you and I have looked at those old data series of the unemployment rate in recessions, and the pattern of history is really consistent. As you see in this map here, although they don't have the recessions shaded, unemployment spikes in a recession. It then spends years coming back down, moderating. It plateaus, but then as it starts to pick back up, it spikes again into the next recession. And we are it's looking like we are seeing that starting to happen here. Now, will that manifest out from here? We don't know. We're going to track it closely. But these unemployed college grads are definitely starting to see a real pickup in momentum here. So I think we need to watch this really closely. And then last, I did have I did just record yesterday, Lance, the interview with Kyla Scanlon that we talked about.
Yep.
And this really was sort of like front and center in her crosshairs, because she just said it's just so important to the younger generation of Gen Zs and millennials that she talks to. There's a real sense of broken trust, I think, in the system in general, but certainly that, like, hey, this economy does not have our interests in heart, and kids just feel it from employers that it's so hard to get a job right now. If they get a job, there's no sense of corporate loyalty, like the company has any sort of investment in them. And it's part of why they are kind of checking out in many ways, right?
Yeah.
Rightly or wrongly, but I think we have a lot of signs of concern in the labor market generally, but very much so, in the new worker space here. So,
but you can't really blame them. They did it to themselves. So, you kind of reap what you sow in a lot of ways. It's just like, look, when you start demanding the use of certain pronouns, or you demand more paternity leave because of this, that, or the other thing, businesses are in the business of business. Businesses have never been loyal to their employees. That's not the business's job. And there's this old kind of this quaint notion that somewhere back in the 60s and 70s and 80s that companies were really loyal to employees and they did pension plans and all that. No, they were just the same way they were back then. They're about making money, and that hasn't ever changed. But in the recent generations, in particular, you talk to older business owners, they don't want to hire millennials and Gen Zs. They're too much trouble. They don't want to work. They don't produce the effort. They want all these benefits without putting in the time. And they're just like, I don't want to hire them. And they're not worth the effort to hire them. So in a lot of this case, a lot of this was done to themselves. And this whole mistrust in the economy is mostly their own doing. And, and again, this is what you get. They lobbied. You remember, we went through this whole deal where everybody was lobbying for MMT for a long time. Well, we got MMT. And how did you like the results of MMT? Yeah, we sent checks to households. How did you like the results? Because that's what you're going to get when you want those things. This is what's going on in New York right now. They just elected this basically a Democratic socialist to the Democratic Party to run the upcoming mayoral election.
An extreme Democratic socialist.
Yes. Yeah. And all the young kids are cheering, yay, this is going to be great. Socialism is going to be awesome in New York. Yeah. Let's talk about this in about 4 years, and let's see how this works out for you if he wins the race.
So do me a favor here. Let's put a pin in this.
All right.
I want to get back to this in just a few minutes.
Sure.
And I look, I can do the old man rant here with you. I think it's mixed, and we'll talk about that when we get back to this. But the reason why before we kind of get sidetracked on this, and it'll be a fun discussion. I want to tie everything I just said in terms of, look, we've got these deteriorating factors going on in core parts of the consumer economy, right? This borrower distress, housing issues, overall maybe now weakness in the employment sector. That all is going to impact consumer spending if these trends continue. That is then going to affect corporate earnings, as you said, is the one thing that markets really care about, right? So right? So a big question here is, what's the Fed going to do in all of this, right? And what should it be doing? And a lot of ink being spilled right now is the Fed, basically proving Trump's criticism of Powell. Is the Fed too late and maybe wrong here, right? You just wrote a piece on this, so what's your opinion?
Well, yeah, my whole piece that I just published today, actually on the website, it's also on our X Substack at Lance Roberts, is talking about the Fed. The Fed has got themselves caught in this fear of their transitory outlook. And, if you look back at history, they came out in 2020, 2021 and said, oh, inflation's transitory. And they got pummeled by the media, by everybody about, oh, it's not transitory, inflation's going higher. And, so they're so tied up into this worry about inflation being non-transitory that they can't get past that view now, even though the inflation was very transitory. If you take a look at history, a 2-year inflation spike is not that long. That's just a bump in the road, basically time-wise, and inflation's come back down towards their target rate. So, it did take longer than what they expected because there was so much monetary stimulus in the system. This goes back to MMT, that you're going to cause this massive spike in economic activity. You had 12% nominal GDP growth. You've got to reverse that to negative before you get to a recession. And so it's going to take a long time to get there. So, yeah, they were talking about transitory and they were thinking maybe a few months. It turned out to be a couple of years, but still fairly short-term in nature, but we're working through that. But they're so worried now about them being wrong again on inflation that he's not willing to cut rates. And at the same time, he's not paying attention to the data. I kind of laughed at his last press conference because he goes, well, we're forward looking. Yeah, that's the worst thing you could have said because the Fed is always forward looking and they're always wrong.
And by the way, he said forward looking a dozen times more.
A dozen times. And they're always wrong. Alan Greenspan back in 1998, 1999 was worried about the inflation boogeyman that was hiding behind the bushes because we're having this massive bubble in the dot-com markets. And he was hiking rates into this, expecting inflation to show up. Well, inflation never showed up, and he wound up supplementing the blow up of the dot-com prices. In 2007, Ben Bernanke's like, hey, subprime's contained. We don't see any risk in this. We're hiking rates. Well, you're hiking rates into a subprime market bubble. What do you think's going to happen when you hike rates into that? Well, of course, we found out that. And then, of course, in 2018, the Fed's hiking rates and is like, hey, we're nowhere near the neutral rate. The economy's doing awesome. 2 months later, 20% lower. The Fed's going, oh, yeah, we're at the neutral rate. Everything's fine. And then they're cutting rates 6 months later to stave off the repo crisis that we had going on. And then by, of course, 2020, they're at zero interest rates. Then they're doing zero interest rates and 120 billion a month in QE, and we had this massive surge in economic growth. You shut down the economy now, and an idiot that just graduated Economics 101 knows if you have no supply and a tremendous amount of demand, you're going to get inflation. Did the Fed raise interest rates in 2021? Did they cut QE back to zero in 2021 to offset the coming surge in inflation? No, they kept the gas on full until way too far after the fact to start doing that. So the Fed, as always, is very, very late. Their forward outlook is always wrong because they're worrying about whatever decision they made in the past. And what this is going to happen is in the next few months, the Fed's going to be cutting by 50 basis points at a whack to try to catch up with the economic data.
Okay. All right. So that's where I thought you were going here. And it's funny, even big Fed critics like Stephanie Pomboy, when I was interviewing her this week, she said, look, I'm like the biggest person to argue against any Fed intervention. Like, I don't want the Fed to be intervening at all. But man, if you're going to intervene, like, intervene when it makes sense, right? So she's even on your page, Lance, right? Where she's like, they should be cutting now, right? So anyways, I mean, there's a growing chorus of people, I think, who share your point of view there, Lance. So what I want to just tell the folks watching here is I think we're seeing enough data points that it just says, hey, you should probably have some provisions in your portfolio strategy here for the risk that I think Lance is laying out here, which is, hey, the economy could start markedly slowing at some point later this year, early next year, for all the reasons we just mentioned here. The Fed may actually get, pushed into panic mode. We may actually have some periods where things get kind of bumpy, both in the economy and in markets. So be careful, if you work for a paycheck, be careful about the stability of your job, and be careful about the impacts this might have on financial asset prices.
Yeah, and the one thing is, like the Fed talked about at their last meeting, is like, we're worried about if we cut rates here that we'll bring inflation back. Okay, can you not look at a chart? Because you ran zero interest rates from 2010 through 2018, and you had no inflation. You were begging for 2% inflation with zero interest rates. So cutting rates, cut rates by 25 basis points at the next meeting. It's not going to change the fact of anything, but at least gives you a little bit of breathing room here.
And Lance, just help me wrap my brain around this. So, Powell has said that he is waiting because he's not certain enough yet what the inflationary impacts of the tariffs are going to be. And what he doesn't want to do is cut rates going into, a new inflationary cycle. But help me understand this. I mean, maybe it's just my fault, but I look at the expected impacts of these tariffs, which we're already seeing, some initial data showing that they're not getting passed through and the corporations are eating them and all that stuff, right? And they're much less than expected so far, at least. But even if they do raise prices, it should be a one-time price shock, right? It shouldn't be a sustained inflationary impulse. So Powell can't really control what's going on there. There's nothing for him to control in that case. So why even worry?
Well, no, I think that's a beautiful statement. And that's the one thing that everybody has overlooked on this, is that so first of all, how do we measure inflation? We measure inflation by price change from one year to the next. So if gasoline is $3 today and it's $3 a year from now, inflation is zero. So if I create a tax, right, and I increase the cost of gasoline from $3 to $3.50, a year from now, it's still $3.50 because the tariff didn't change. My inflation's zero. I have a short-term impact, but not a long-term impact. But the Fed can't do anything about that. That's not a function of the economy overheating or a function of anything that interest rates will control. That's a change in a tax, and the Fed can't control it. So there's no reason to be looking at tariffs going, are tariffs inflationary? First of all, they're not, because we're already seeing this as an issue. Nike just reported they're taking $1 billion charge because they've got to eat the tariff pretty much. So, that's what we've been talking about for a long time, but this isn't something that's economic. It's not a monetary policy issue. And so he's worried. And this goes back to my point about my articles. They're worried about this transitory misstatement that they made, and they're worried about being tagged with that again. And they're letting that cloud their judgment about the impact of tariffs on the economy. on a one-time event.
So thank you for validating that, because I've been kind of feeling like I've been taking crazy pills on this. It's akin, Lance, to him saying, we're going to wait to determine our monetary policy because Congress is going to pass a new tax and we want to see what happens after that. They never do that because they don't have any control over it.
That's correct.
Yeah. So, okay. All right. Well, look, folks, go read that article on wherever, Lance's Substack, realinvestmentadvice.com. All right. So I do want to get back to the conversation we're having about Kyla and Gen Zs and millennials, but we'll make that the rant today. But before we get there, why don't you share your trades? Because it sounds like you have made some.
Yeah, we made quite a few this week, actually. So once we broke out of that consolidation range, first of all, you have to understand is that there's a difference between the market and individual equities. So just because the market is overbought and at all-time highs, et cetera, that doesn't mean all the underlying stocks are necessarily in the same case.
Right. And we talked about this earlier. Folks already know, AI stocks driving the market, a lot of other things not nearly getting the same love. Yeah.
Correct. And so there were some stocks that we've been watching for a while. We talked about this previously, is that we're starting to position the portfolio a little bit for this kind of coming AI infrastructure build out. We've been slowly kind of building some positions along that way. Michael Liebowitz just wrote a really good article this week. It's on realinvestmentadvice.com talking about behind the meter. And it's about the power demand, meeting the power demand needs that these AI data centers need to have, but they can't get it off the grid. So they're going behind the meter and tapping directly into natural gas pipelines. So we've been looking at Kinder Morgan Energy as an example of a pipeline company we wanted to add to our portfolio. We bought that this week, a starter position, not the whole position. BlackRock is very heavily involved in the infrastructure build out of data centers, et cetera, also just infrastructure in general. So we've added a start, and we also needed some more financial exposure. So we added to BlackRock. We also added to our position in Berkshire Hathaway just because it's a stable defensive position in the model. So we kind of added those positions there and then rebalanced some of the other stuff in the portfolio just a smidge. In the dividend equity model, we actually swapped out two stocks. We sold FRT and Medtronics. One was FRT is a real estate REIT. We had more than market share worth of REIT exposure in the dividend equity model, so we removed that. And we added UGI, which is another company that will benefit from kind of the natural gas build out side. It's got a very nice dividend yield for that. So we added that to the dividend equity model. We also added Amgen in place of Medtronic. Medtronic's is okay. It's been underperforming. So we added Amgen, which has an equivalent yield in the dividend model. And then we rebalanced the rest of the portfolio model about halfway back up to full target weight. So that's pretty much, most of it was just kind of jiggering around the edges a little bit, just a little bit more equity exposure, because with this breakout in the overall market, we're starting to see more pickup on a broader base across the market. So it's just helping portfolio returns this year.
Okay, great. So folks, if you want to get the full detailed list of what Lance just mentioned there, Lance shares them through his SimpleVisor service. He shares it through his Bull Bear report that he publishes every week. That we also share that in the Thoughtful Money write-up that goes along with this video. So if you're subscribed to the free Thoughtful Money Substack as well, you'll find that at the bottom of today's summary here. So plenty of ways to go get that list. All right, Lance. And you putting your money where your mouth is. You've been saying that you have been waiting for better entry points, and when they happened, you had a shopping list that you wanted to start going to town on, and it sounds like you have.
Yeah, no, it's just that. Again, don't necessarily, I got a lot of emails like, yeah, but the market didn't pull back. Well, sometimes it doesn't. Sometimes it just consolidates. Again, as we said earlier, it's either time or price, and time's been a good factor here. So, and again, we're not going crazy, right? We're adding, starter positions. So as always the case, we buy a position, we buy 1% of it relative to the portfolio. And then, one other one we bought was ServiceNow. NOW is a symbol there because they're actually in the AI kind of space itself. But we buy 1% of the company. And if the trade starts to work, we'll build that out up to its target weight in the portfolio. If it doesn't, it was a small starter position. If we bought it wrong, the technicals change, it doesn't work out the way we thought, we don't have a huge risk in it. So it doesn't really have an oversized impact to the portfolio. But hopefully we get these entry points in, it starts to perform well, and then we're able to build that position over time and make it a fairly sizable position in the portfolio. But that allows us to keep our winners and minimize our losers as much.
Okay, great. All right. Well, look, let's transition to the rant and then we'll wrap up here. So let's get back to Kyla. I really don't want to make this kind of, the boomers and X's beating up on this younger generation.
No,
We've talked
it
about,
shouldn't be that at all. What I'm talking about is that this is from I am a business owner. I hire employees all the time. And I can tell you as a business owner and all the business owners that I deal with, I will just give you our perspective on who we hire and what we're
yeah,
looking for. And if you're a college graduate and you're looking for a job, I can tell you what employers are looking for.
yeah, and we've kind of talked about that. So I know where you're going with this. Just put a pin in that for a second.
Yeah.
Um, so Kyla's point, as best I can tell, is look, this younger generation really has very little faith in the system for a whole series of reasons, right? And they look at, and I know you've got
Well,
maybe
no.
some differences of
So
this.
when you say that, what do you mean by that? You say they have very little faith in the system. What system? What is their issue with the system? What is it what's their grievance?
Right.
Let's
So
identify that. Let's not leave that in this big massive cloud of
yeah,
whatever
no, no, no.
anybody wants to make out of it. Let's define it.
I'm going to clarify.
Okay.
And so it's things like we've talked in the past, and I know maybe we have a little bit of a difference of opinion on this. I mean, I think
Sure.
you and I think very similarly, but like from an affordability standpoint, a lot of the basic life milestones are more unaffordable today than they have been in previous generations. You can still do it, and you and I have talked about this. You can pull yourself up by your bootstraps. You can live super frugally. You can live in your car as you did. There's still ways to do it, but on average, it is harder to form capital today than it was. It is harder to afford a roof over your head. It's harder to afford a family. Things are just more. It's harder. They literally cost more than they did, and the job opportunities are not as they haven't increased commensurate with the costs, right? So there's a sense, right or wrong, there's a sense of these kids that are like, hey, we're kind of getting we're stepping into a system that has kind of been milked by the generations before us, and we feel like we're getting a bad deck here, right? In when it comes time to corporate America, right, it's a sense of rightly or wrongly, there was a period of time where, back in the 50s, whatever, people got hired, they tend to spend their whole career with a single company. The economy was doing better in general, back during those boom times, whatever. We all have the idealistic 1950s, America in our heads. They now see a corporation or a corporate culture where, look, if we can't outsource or automate your job, sure, we'll pay you until we do, right? But there's a strong sense of like, I'm not getting invested in my development in this company. I feel like they're going to drop me the second that they can put in some sort of technological solution that is more cost effective than me, right? So now they also have plenty of issues that they bring into the workplace, given the mentality of the generation. And Kyla admits that, right? So Lance, some of the things you were going to rant about how these kids want, nap time and, only be able to work 3-hour days and stuff like that. A lot of that is there, particularly with the Gen Zs. I asked her at the very end of the conversation, I said, what would you like our older generations to know about yours? And she said, you know what, like, especially with Gen Zs, she's like, COVID really screwed us up. And as a result, and maybe even our parenting, screwed us up, whatever. But like, as a result, you're right. We didn't learn how to be in a corporate culture. We didn't learn how to interact with professionals and learn from older people. And when we're bringing in a lot of kind of like, almost like a social PTSD around that. And we just need some help. We just need a little bit of understanding. And instead of getting frustrated with us, which is an understandable response, if you could just be a mentor, if you could just help teach us how to do this. Like we want to listen, we
That's
want to be better,
that's
right?
not that is not the role of an employer.
It's
That is not the role of an employee. Look, we have 30 employees in our company, right? When we hire somebody, we expect you to come to work prepared to do a job. And we pay you very well for it. We pay above average market rates and compensation for our employees. We provide annual bonuses. We provide profit sharing. We pay 100% of their health care. We pay 50% of their spousal's health care, fully fund their 401k plan, full match, the whole 9 yards, right? So we take very, very good care of our employees, but we expect them to show up with a skill set and perform that job effectively. And if you come to work and you're like, oh, well, I need somebody to show me how to do this. When I hired you, you said you knew how to do this. This isn't a learn on the job type situation. You're supposed to have the skill set to do this. Now, if we hire you into a role and you're not at the level that we want you, but we see talent there, which we do this all the time, we'll hire somebody who has a lot of talent in a specific area or a lot of ability, and we will help educate them. We will send them to school, we'll send them to training, we'll get them certified, we'll get whatever they need to make sure they have the skill set to do it. And we will buy them all the tools that they need to do their job effectively. But we expect you to show up to work on time, work a full day at the job, and probably work overtime, because this job that we're in is a very high touch, white glove customer service business. We put our clients above everything else in terms of what we're doing, in terms of making sure service standards are met, which requires more than a 40-hour work week. So you're going to be working on Saturdays. You're going to potentially be working on Sundays. We have client events that you'll be required to go to. We have, outings, family gatherings. We have all kinds of stuff that we invite our clients to. You're expected to be there. You're expected to be there to support your clients. If you're a client advisor or if you're a support staff, you're expected to be there, put a name with a face. If somebody calls you, you're expected to answer the phone, not roll it over to voicemail. So these are just all the requirements. It's not our job as an employer to instill into you a work ethic. That's you're supposed to bring to the table. And what you bring to the table is going to be how you're compensated. The more work you bring to the table, the more valuable you set yourself up to be as an employee of the company, the better you will be compensated. And look, we have a lot of our employers that make well in excess of $100,000 a year, because they do an exceptionally good job and they are worth every penny that we pay them. But it's something that we require of them. And if you don't want to do that job, we've had a lot of employees that are no longer with us because they didn't want to meet those requirements. They expected that, oh, they could just take an inordinate amount of time off. Or we had one employee that was working 2 full-time jobs during the whole lockdown period during the pandemic, kind of double dipping.
yeah.
And, those are things that we just don't tolerate. So look, but that's just business. We're in this business to service our clients, make sure that we do a good job for our clients, protect their assets, grow their wealth, and make a profit at the end of the day.
So
we're happy to share that profit, but you have to earn it.
Yeah, I don't disagree with anything you're saying, and I agree that this is the tough love that this generation needs to hear, right? I'm putting some words in Kyla's
Sure.
mouth here, so if I get a little bit of this wrong, Kyla, please don't. It wasn't intentional. I think her general point is, and look, RIA is always going to try to hire the cream of the cream, right? I mean, they're might be a smaller percentage of the Gen Z population, but there are an absolute number of Gen Zers who've got a great work ethic and have studied hard and are bright and shiny, and you're going to hire those top performers, right?
Yep.
I think her general point was just for boomers and Xers to understand about her generation is kind of like, look, we kind of got screwed up by helicopter parenting, right? Like we agree in retrospect, right? We were overparented, get addicted to digital devices and kind of rotted our brains. We went to colleges, and this is another one of the things about the system not working for us. We spend way too much money for degrees that really weren't very useful for us, right? And then, many of us got into the workforce right when COVID hit, right? And then, we were basically forced to work from home, and we didn't get to learn how to be in a workplace environment and all that stuff. So we kind of have all this like screwed up stuff. And just like, if we're not perfect from day one, but we show the right potential of like, I want to get this right, just help direct this, kind of like your
And
company does, right? Yeah,
and
if you,
that's all my, but all my business associates that I work with, they're the same way. I have a really, so my mentor, right? He owns a restaurant here in Houston, and he is super successful. And he is one of the, if I could have any boss in the world, this would be the guy I'd want to be my boss. But he is a hard ass. And if you don't perform, you're gone. There is not a second chance. If you mess up once, he'll forgive you for that. Two times you're gone. But he will support you. He will be there. He will encourage you. He will mentor you. He will give you whatever you need until you either completely fail on your own, or you take advantage of the situation. And that he has very little tolerance of. And that's most business owners. Look, at the end of the day, employees are the most expensive thing any business owner has to deal with. They are the highest cost of any business's payroll. Every business owner invests an inordinate amount of time and capital in developing a good employee. So this is why, when we talk about employment, and a lot of times we'll say, employment rate, unemployment's coming up a little bit, but it's really not spiking yet. That's because employers hold on to employees. It's their lifeblood, and they hold on to good employees in particular as long as humanly possible. They
because you
will
made a
bleed
huge
into
investment in
profits.
them and they're valuable. Yeah.
Yeah. And they will bleed into profits before firing those, because once you fire a really good employee, they're impossible to get back because they'll go to work for somebody else eventually. So the point is that every employer is willing to help you. All you have to do is ask, and all you have to do is show effort, and all you have to do is be there. Look, we've got 2 interns right now we hired for the summer, and we hire interns from colleges around the country to work with us during the summer. And these are guys that are graduating with financial planning degrees, et cetera, from Texas A&M University. These are the sharpest kids that I have met in a long time. Super polite, well dressed. They show up on time. They do their job. They don't ask, for just out of the world stuff. But they're very inquisitive and they want to learn. And they're showing, and what these guys show is they take very good direction. They will do whatever you ask them to do without question. They don't hem hawing around about it. They don't waste time. They don't fiddle fart, etc. But they ask questions like, "Hey, I really want to learn this," and they show an intuitive ability to learn, and they're letting their employers know it's like, "Hey, I really want to be here and work." And if you do that, you're going to keep your job. You're going to grow with that company. And we talked about this with minimum wage before. There was this whole big debate about we need to pay higher minimum wage. Minimum wage is a test salary. If you're on minimum wage for more than about 6 months, the problem's you, not the company, right?
I'm just going to interject, wrap this part only because there are some bigger topics I'm trying to get to in all this. So, and I'm not disagreeing with anything you're saying here.
I'm just so wrap it, go. But you get the point, right?
So,
I mean, but ask. If you just show interest, companies will help you.
Yeah, and so Gen Zers, if you're listening, take Lance's advice there. We're just to put a bow on this part of it. Lance, again, you're going to hire the best and the brightest. I think what Kyla is saying is like, look, we're all in this together. We've got this cohort coming of age that has the screw up factor in their past, right? And we can either just let them all languish, or we can try to meet them where they are and say, hey, look, you need some tough love here. We're going to give it whatever, but something that just tries to help this not become a generation.
It's not the way business works.
No, it's not the way
we're not in this together.
But it's not the way your successful business. The thing is, we have millions of these kids going out into the workforce. We can either just let them drown, or we can say, what can we do to try to help save the ones that can.
And what's happening with these guys look, these guys that went to college and got useless degrees and whatever they were, got degrees in queer studies and gender studies and blah blah blah.
Yep.
What are you going to do with them?
So damage is done.
How are we in this together? How are we supposed to help them succeed when they have gone off into a path of life that has no financial need for a business?
So I don't know if I have the answer, but I think the question is either, do we just let them drown, or do we do things socially, commercially, whatever, to say, for those of you who want to improve your station, here's some training, here's some skills, here's the tough love you need to hear? Or do we just say, sorry, guys, you're done, right?
No, no,
I
it's,
understand the
look,
cutthroat Darwinian nation of capitalism. Don't get me wrong, I'm a capitalist.
businesses are not in the business of helping you. That's not their job. Their job is to make sure their businesses are operating. They're gonna every business hires the best person they can find to work for them. So if you went to college and you got some degree that is not useful for a business, they're not going to hire
Right.
you.
So
We're
here's an
not we're
example
not
though.
in this. This whole idea that we're in this together somehow is completely useless because we're
Let,
not
let,
in this together.
let,
And
let-
so what you've got as individuals, we have to take responsibility and say, look, I went to college, I got a degree that nobody wants. I need to go get some other training and go figure it out. It's
yeah. So
not, it's not in this together. It's you have to do this for yourself.
So you and look, we see the world the same way, Lance, through so many lenses,
Okay.
and as runners of our own business, exactly right. Think societally for a moment here, right?
Okay.
We've got a cohort of workers entering the commercial world who maybe have, some disadvantages or lack of whatever that we need in the workplace. We collectively have a problem. It's like the old if you owe the bank, $10,000, you got a problem. You owe the bank $2 billion, the bank has a problem type of deal. We have as a industrial work fleet or whatever, we have a problem if a good chunk of our cohort is not ready to step into this world, right? And so I don't know the answer, but what can we do? Well, maybe we do some private public partnerships where there's programs where you know uh, private entrepreneurs are coming to colleges and saying, hey, look, we're seeing that your cohort is not prepared. You need to have da, 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 da by the time you graduate. And things that I don't know, but I think that's just what Kyla's asking for. Is just like,
I think she's
is
talking
there
about the
is there an
minority.
arm we can reach out societally to help this, right?
But look, like I said, we go to A&M, right? And we go to other universities as well, and we recruit from other universities because we want to get these guys, we want to get young employees that we can train our way, right? The hardest thing to do in our business in particular is retrain somebody from another firm because they've gotten educated in buy and hold or whatever. And trying to break that mentality is really hard. It's much easier to catch somebody young and then grow them into the business, right? It's better for us. But when we go to these universities, I don't, I think a lot of this stuff that we're talking about is the minority. It's not the majority. Or maybe I'm only seeing maybe I'm wrong. Maybe I'm only seeing the minority, but the group of kids that I see coming out of colleges right now, in particular, they're young, they're bright, they're smart, they're motivated, they're getting good degrees and good, whether it's computer engineering or computer science or healthcare of some sort. There's a few that are kind of on the fringe that maybe they're going to make it, maybe they're not. But again, I think there's a lot more of these kids coming out of universities that are coming out with the right attitude than not.
I don't know. Maybe, and again, I'm listening to Kyla, who is from this generation, but I've certainly seen and heard a lot of the complaints that you have as well of employers. I think you're seeing some selection bias, Lance, which is you're seeing the kids that are showing up to you when you show up on campus because they're
I
interested
said
in working
could
for a
be.
job like yours, right?
And no,
So
it could very well be the case, but you know, you know, but again, we have to also remember is that the people that we hear about complaining, right, are the vocal ones, right? If I'm doing okay, if I've graduated college, I'm doing okay. I'm not complaining about stuff. I'm just going to work. So we're hearing from, Kyla's hearing from the ones that are, the outcasts, the
yeah,
downtrodden, the
but she's got a
despair, and
massive
those type of
platform.
things. Yeah. And so they gravitate to that platform because that's where they get their voice heard. But the question is, and I don't know the answer to this, is do they represent the majority or do they represent the minority?
All right. Well,
Because
let me put it this
again,
way. I would say Kyla's got her finger closer to this pulse than we do, at least in terms of how that generation feels. And
mhm,
look, I want to get to the more interesting things that I was hoping to
sure.
talk about here, but uh, let me just say this, Lance. I think you're looking at this like I would normally, which is from me and my business, right?
Right.
You're a small elite shop, right? I mean, there are employers out there who hire thousands, tens of thousands of people a year,
Sure.
right?
Absolutely.
And this is a collective problem that they have to deal with. And you multiply those by all the big employers and stuff like I think all she's asking for is a little grace. She's not saying do our work
Oh,
for us. She's just saying, look, kind of understand the nature of the damage and try to try to keep that in mind as you try to pull us along where you want us to go. And yes, if we're not doing the job, cut us off, give us the tough love, whatever, but just don't give up on us right out of the gate.
And I don't think anybody's given up on anybody out of the gate. I think that's a misstatement because again, every company needs new employees. So I mean, you've got older employees that are retiring. You've got to bring in newer employees, et cetera, along the way. That's just going to happen. And I don't think anybody's given up on anybody. I think that, but we do have to be responsible for our choices. And we can't expect that businesses are going to just accommodate us for all of our things that we want. We want nap time and we want, extra vacation.
And just to be clear, she's not asking for that. She understands that.
I get that. That's what I'm saying. And again, I don't know any, and look, I know some owners of really big businesses that have thousands of employees, and they are happy to help with education. They will pay for you to go back to college. If you need to go back to college to finish your degree, they will help pay for you to go to college. They are happy to help educate you because a better educated employee is a better employee, and a better employee is more profitability for the company. So, companies are not unwilling to assist with any of these things, but they're not going to do it just out of the goodness of their heart. You're going to have to show up and show them that you're worth the cost and that you're worth the effort. And if you're not willing to do that, no, they're not going to help you. But I don't think there's this idea that, companies are just like, I'm just going to write this whole generation off. They can't write this generation off because they need them.
That's my whole point.
Yeah.
So, okay.
But at the same time, they're not just going to give you stuff for free.
I'm right there with you. We're not talking about socialism. We're not even talking about compromising capitalism. We're just trying to say, understand that these kids are coming out kind of shell-shocked. And, if there are ways to help with the onboarding, in ways that can.
I think that if I had to give advice, so this is the advice I give to my kids. So is like, get off of social media. Make sure, first of all, you're not posting anything on social media while you're in college that's going to come back and bite you in the ass, because your employer is going to look at your social media. And so if you've got social media pictures of you hanging out there in bikinis and drinking and, doing whatever, probably not going to get hired, right? Because your social media is going to represent the type of employee that this person is hiring. So what you put on social media is part of your resume. So understand that very clearly. What you do with social media will follow you into your employment. Second thing is that you need to start thinking now about building relationships with employers that you want to go work for. Go intern with them, show up, ask questions, find people that work for the company, start building a relationship with them, talk to them, ask for advice, ask for help. They're happy to do that. They love doing that type of stuff. And that opens the door for you to get a job with them. But then most important, like I have my son doing this right now. So my son is in a junior year in A&M working on computer engineering. I've got him calling the companies he wants to work for right now, talking to the human resources department, talking to people in the company, saying, "Hey, look, I'm a junior in college. I really would like to come potentially work for a company like you when I graduate. What do you look for in a new hire coming out of college? What skill set do I need? What experience do I need to have under my belt already? What type of specialization do I need? What are y'all looking for?" And he's doing that job now so that he's prepared when he comes out of school to have the right skill set that they're looking for. Because in the AI space in particular, computer science, computer engineering degrees are having a hard time getting hired right now because they're not specialized enough for AI. So you've got to make sure and have the right skill set. But these are all things that you need to be, these are your responsibilities to do. And these companies are happy to talk to you. They love talking to people. All you got to do is just call but you have to put in the work. You can't, my biggest challenge with my kids is getting them to pick up the phone and call somebody because they're so used to texting.
They're so used to texting. Yeah.
Yeah.
All right. Look,
you got to stop that. You got to start calling people and talking to people face to face.
I'm going to stop you here just because I agree with everything you're saying. This is actually really near and dear to my heart. I've got some other best practices I'd love to pile on top of yours.
Sure.
But I want to get to the key points I want to be talking about here.
Do it.
So we got to cut this.
I'll shut up.
What I will say is, folks, if you didn't watch the free webinar I did earlier this week with Ted Oakley about his book on raising money smart kids, Folks who attended that really appreciated hearing all of Ted's wisdom on that. Lance, you and I could probably do one on pretty easily on, hey, how do you raise kids who are prepared to enter today's workforce? You know, all these kind of best practices that you just listed a
Mhm.
bunch, and I've got a bunch to add to it. Folks, if that would be of use to you, if you've got, you know, adults and younger adults in your life who could benefit from that, let us know in the comment section. If there's enough of that, Lance, we'll do our own free webinar on that. We'll get it and we'll go through our
Sure.
lecture, right? Okay. Um, all right, man, guys, Lance was like a dog with a bone on that one. I'm sorry he woke
Oh,
up.
and this is a very hot topic for me because I deal with this with my kids right now.
Oh,
And this is a very, very hot issue for me because, you know, I'm in the middle of this with my kids right now.
okay, we're moving on from this though, because we
Go
got to.
ahead.
So there were a couple other important things, or things that really caught my attention in the interview with Kyla, which, by the way, folks, is going to come out either the day after this video releases or a couple days after this one's, but it's coming out soon. Um, I think one of the things I've really been chewing on since talking with her is we were talking about the results of the New York election, right? And how this extreme Democratic socialist just got elected there. And Kyla agrees with her, you know, practical hat on that his policies are unworkable. That was her words, not mine, right? You know, these are socialist programs, you know, that have failed all throughout history, you know, state-owned grocery stores and, you know, all that type of stuff, right? Um, but she said, you know, she wasn't surprised from the results of the election. One, because she understands that a lot of the younger generation is sympathetic towards these policies because they've really lost faith in the system, and it's like, look, yeah, I'm pretty sure I'm going to get screwed whoever wins, so I may as well vote for the guy who's promising me free stuff and at least get something out of this in the short term. But the thing that really stuck in my mind was. She said, no, you could really tell that this guy Mandami was picking up steam and likely going to catapult out front because he was in all the places where the growing majority of voters now is, which is on social media and Lance on platforms that, well, I'm not on, maybe you're on, but like she's like, he was on TikTok, he was on Instagram and stuff like that. And what really hit me in that was I think if you're a boomer or an Xer like me, um, you know academically that there's going to come a point where the younger generations are going to become the majority, and that they have a different way of life than us, and their way of life is going to become the majority of way of doing things. Um, and we think, okay, that's going to happen at some point in the future. And talking to her, I realized, oh my gosh, that day may be much closer than I realized. In fact, it may already be here, and that they are determining the future in areas that I'm not even on anymore, right? You know, we had our debate about short form and long form content earlier, Lance, and I'm going to
Yeah.
give you I asked her about that. I'll give you her answer in a minute. But it really did kind of jar me that like, oh my God, like things that are now like determining major election outcomes and stuff like that, they're happening in a world that I have no view into right now because I just don't
Right.
use these things.
Yeah. No, it's true. And look, you know, fortunately, what's going to happen is that, we had a good taste of kind of socialistic monetary policy during the COVID crisis,
COVID,
and
yep.
that didn't work out well for people. People didn't, but see, the problem is that people didn't understand that. They didn't understand that what we did, which was socialistic monetary policy through MMT, was the culprit of
Equaled
why
high
you
cost
can't
of living.
afford anything. Right.
Yeah.
They didn't make that connection. But when you vote enough of this stuff in, where great, let's have socialistic, kind of rent price controls. I've had government-owned grocery stores, et cetera. When you realize what the net effect of that is, then people are going to change the way they vote in the other direction. And so we'll go through this. Unfortunately, we'll have to swing the pendulum a little bit too far in one direction. But then people will come, hopefully sooner than later, they will come to realization that that's really not what they want. And what they want is what was creating wealth for the generations before them, which was capitalism.
So I agree with you, and I'll take the under on a Mamdani administration meeting. I think it's going to end in tears, and it may be the thing that really puts the the stake in the Democratic
Look, let's be
Socialist
honest.
Progressive.
It's New York. Neither candidate is good for New York.
No,
So
but I mean, look, if you who are the knights of New York, right? It's the privileged class. It's Wall Street, right? Those guys
yeah,
have got to be just crapping their beds right now at the prospect of a democratic socialist like this guy getting in, right?
yeah.
Which is why, I mean, it's super clear. You're just going to see if he does indeed get elected, you're going to see a massive amount of asset flight from New York, right?
Well, it's
Uh,
already happening. I mean, you've had what they were talking about the other day, like $275 billion worth of assets or something leaving New York already, just
Already,
in the
yeah.
last couple of years. It's been quite incredible.
Right.
That's just
For the
killing the
guy's
tax
platform,
revenue.
which is basically, I'm going to tax all that wealth. By the time he actually gets into office, it might not even be there anymore.
Exactly.
So anyways, we'll see what happens there. That's not the point I actually wanted to talk about here. It was the point of like, look,
We'll get to the point.
well, no, which I made, right? Which is like, hey, if we're boomers and Xers and we want to be relevant or at least even just
Mhm.
participating in the world going forward, we may actually have to change our behavior because what's driving things is now beginning to happen in the areas where we are not, right?
Yeah.
So we may need to get off, CNN and MSNBC and Fox News and reading the journal and whatnot, and we may literally have to find a way to exist in some of these platforms that we've just said right now, that's trash. I'm not going to look at
Yeah.
it.
Yeah, but I think we may be seeing more of that. I mean, I think we saw a kind of a change, post the election, is that we kind of start seeing that pendulum kind of swing in the other direction a bit, which is good. We'll see if we can maintain that, through the midterms and through the next election. But it does seem that there's a shift kind of from this, kind of went this whole woke side for, during the Biden administration. It looks like we're trying to come back to at least a bit of more kind of normalcy, where things will operate a little bit better, economically speaking. So, but yeah, but again, there's so many risks to the economy right now. The economy is definitely slowing down. You don't have, the underlying structure to help support economic growth right now. So, one of the things that are going to impair that movement kind of back to more of a neutral position is another recession. So if we do have a recession, that's going to swing this pendulum back in the other direction,
Direction.
unfortunately.
Yeah. And I disagree. Again, I think that's kind of a separate conversation. Maybe that's another future exploration for another video, Lance. I'm just
Mhm.
going to make this last point and then I'll move on to one of the last things I want to mention here. But like, my point is like, look, let's say you're a boomer now, right? And you want to A, know what's going on in the world, right? But also B, maybe like, in the past, like, oh, I don't want people to cut my Social Security benefits, right? So I'm gonna write to my cable station and say, hey, I want you to. This is important to me. Cover stories that protect seniors and Social Security over, right? You might be much better served finding a TikTok influencer who shares that view and writing to them. Or the point is like what worked in the past for the interest of the older generations probably is not going to work that same way going forward because the action is just happening in these different mediums now.
Mhm.
It really made me say like, look, I've not been spending any time in TikTok or Instagram or stuff like that, but I may have to just because the news that's going to influence and drive the increasing majority of people who vote and do things in the world is going to be happening on platforms like that in the future.
But the problem with this is that, of course, is that it's just like the mainstream media, is that it's all echo chambers. So you're going to get onto TikTok and you're going to start following the people that agree with you, and you're going to have yourself in this echo chamber of whatever it is that you're wanting to hear, right? And that's a big factor, that goes on, is these kind of echo chambers that exist, and you get one of these influencers that, for whatever reason, whatever identifies this particular influencer as the person, they'll generate a very big following of people that are very like-minded to them. And so the problem is that we have in the country is that we don't have a good discussion about the facts. We have echo chambers of whatever your personal view is. And look, there's people that are going to disagree all over about this video today that we're talking. There'll be people that agree with us and people disagree with us and whatever. But the problem is we can't just have an honest discussion about the facts of all the stuff that's going on because everybody's in their little
Everybody's
siloed
picking their
echo
selected
chamber.
news source.
Yeah,
Totally get it. And again, another topic for a different day because
yeah,
we're not going to solve that tomorrow. My only point is that the discussions, however imperfect, that are out there in the world. It's the ones being held on these new platforms that are
Mhm.
now increasingly influencing people, like ousting a big establishment candidate like Cuomo by this crazy dark horse that nobody thought could or should be in that position, but he did, and he did because he really milked these new platforms that a lot of us just don't pay any attention to. Okay,
Well,
I've beaten
no,
that horse.
Obama set that precedent back when during his first election. He was the first guy to actually use social media to a large degree, and it won him the election.
Right. And this sort of my point here is like, we're getting older, so we are becoming the dinosaurs, but like we will really suffer the dinosaurs' fate if we ignore the fact that the world is changing, right?
Yeah, I'll be dead soon, so it's not going to matter.
Oh, come on, man. You're going to be here forever. Okay, so two other things that I think are fun, and then we'll wrap up. So one, I did ask her about the future of long form versus short form content. And I
Uh-huh.
told her that we had a debate, Lance, that you said you thought long form was dead. And I said, you know what? I agree that short form will continue to be on the rise, but that long form will always be there for the people that want to really learn something in depth, right? And Kyla totally agrees with me. So
She doesn't do long form. I have not seen her do any long form.
she does long form. She doesn't do
I've
long
not seen
form.
any
She
of her
doesn't
long
do
form.
long
I
form
only see her
video very
short.
much. Yeah, she doesn't do long form video very much, but she has a Substack where she writes long form articles. She just wrote a book, a very long form piece of content. So, and she said absolutely, the short form stuff is to hook people's interest, get them to care about the subject, feed them little bites that make them realize why finance is important to them. But then when they want to learn in depth about financial concept X, you transition to a long form experience. So, anyways, I feel totally validated, whatever. The last part, and this was really fun, before we turned on the camera, we were chatting and I thanked her for coming on and told her I was very impressed with what she had created and what she was doing. And, said it was a privilege to have her on the program. And she said, well, thanks. I'm very happy to be here. I got to be honest, my dad watches Thoughtful Money, heard you talking about me potentially as a guest on the show, and said, hey, this guy's thinking about having you on his show. You should totally do this. So huge props to Kyla's dad. Big honor to hear that he actually watches the show. But yeah, the fact that unbeknownst to me, he was already watching and then thought highly enough of our crazy rants here, Lance, to say, hey, Kyla, you should get involved. That was really nice.
Yeah, that was nice.
Yeah. All right, folks. Well, look, if the nicest thing that you can think to do with your time going forward is to watch Lance Roberts every week on this channel, please let him know that by hitting the like button and then clicking the subscribe button below. If you can click that subscribe button too, folks, I'm just going to pause here for a second to say it really does help us. I was looking at the percentage of people who watch these videos who are actually subscribed to the channel, and it is much lower than you would expect. That's not uncommon for YouTube, but the higher percentage of the audience that is subscribed to the channel that watches the videos, the more love that YouTube gives the channel. And so it takes you only a second, it doesn't cost you anything, and the benefit of subscribing is every time we have a new video, YouTube will send you alerts so you know not to miss it. It's kind of a win-win-win for everybody. So if you can just take a quick second, if you're not already subscribed, click that button, or if you think you're subscribed but you're not sure, click it again. That'll be helpful for this channel. And lastly, as we were talking about earlier, before we got whole sidetracked by the whole Gen Zs in the workplace discussion, or Lance got that bone in his mouth. Lance was telling us that he thinks, this is still likely to be quite a volatile year, and he does have concerns about where the economy is ultimately headed and what that might do for markets. So highly recommend that you take at least some planning precautions in your portfolio to say, hey, if volatility does increase from here, if we end up maybe, getting worried again about going into recession, if the market starts seeing some greater turbulence as a result of that, how's my portfolio going to fare? If you've got a good advisor who's already, advising you on that and crafting a personalized strategy for you, great, you should stick with them. But if you don't, or you'd like a second opinion from one that does follow all this stuff closely, maybe even Lance and his team there at RIA, then consider scheduling a consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you might even want to talk to Lance himself. So to set up one of those consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill these forms out, and the firms will be right in touch with you to help you out as soon as you do. All right, Lance, we made it through the end of another week. Wow, this one was a lot rougher at the end than I thought it was going to be, but we made it through. As
Well, just
usual,
because you pick a hot topic.
yeah. Well, you're a passionate man, and I know it's coming from a good place, Lance, even though sometimes the tough love feels extra tough. But no, I appreciate you doing it. As usual, I'll give you the last word here.
I will. So just remember, next week you won't have me. You'll have Michael Leibowitz next week to talk all about the Fed, bonds, interest rates, whatever y'all want to talk about. I'll be back the following week. I'm going to go see my son. So flying out to the UK this weekend.
All right, have a great trip. Have a great time at Clarkson's Pub, and look forward to hearing all your stories from that when you get back the
You
following
got
week.
it. You got it.
All right. Have a good time, buddy. Everybody else, thanks so much for watching.